righty. Give everybody a couple minutes to get on here.
Yeah, hi and good morning, everybody. As you're getting into our virtual classroom, I guess.
All right.
All right.
Looks like we're good. I think we can go ahead and get started.
All right, great. Thank you, everybody, for joining us. Welcome to our first, which may develop into a series of Ask Us Anything. This topic, we decided to do the allowance for loan loss because as Chris and I were talking and brainstorming some different topic ideas, this is one of the things that we're getting a lot of questions on with the pandemic and everything that our clients are experiencing in their loan portfolios. Just a reminder, I'm sure everybody has been in plenty of these Zooms and webinars over the last several months, but please, everybody's audio is muted. Please stay muted. We are going to be looking at questions in the Q&A and in the chat functions. You'll find those on the taskbar, so please use that to communicate with us. We'll definitely be moderating that during the presentation. The slides, we will follow up with the slides. They'll be emailed to you after the webinar is complete. And then we are recording this webinar, so we'll email that to you as well with the slides, and then also a survey to let us know maybe how we did, and then also if there are any other topics that you'd like to hear from us in the future. Today you do have myself, Allison Wester, and then also Chris Trainer, our co-host or co-presenter for today's presentation. I'm in our Bradenton, Florida office. Chris and I work together in the Atlanta office for quite a few years, probably more than we want to acknowledge. And then Chris works in our Atlanta market.
Thanks, Allison. Yeah, the two of us are heavily involved in the financial institution industry, as you can see from our bios. Both of us have worked almost exclusively in that industry, although we do have some experience in other industries, Allison in governments and some healthcare type work, and myself in the manufacturing industry, but predominantly financial institutions, and is where we spend the majority of our time. And so before we get too far into the bios here, we probably go ahead and move on so we can make sure we get to all the questions that came in.
Perfect. I'm going to take a few minutes and talk about, before we get to your questions, we're going to take a few minutes and talk about where we are now, what's happening right now, what's generating a lot of the questions we're getting. We are going to answer the questions that were submitted. We got several questions. We kind of grouped them into larger topics so that we could talk about it. And then update some regulatory information. The regulators continue to produce information, so it's important if you are not signed up to some of their mailing lists, please do, especially if you're a primary regulator. And then we'll go over any questions that may come in while we're talking, and then wrap up our time together today. So the next thing, a little bit about where are we now? We're at historically low interest rates. The Fed has indicated that these rates will continue beyond 2021 potentially. They've already telegraphed that information. We've got federal loan programs that are impacting the balance sheets, both from a lending perspective with PPP and other programs, and then also impacting balance sheets from the borrowing perspective if your bank has participated in any of the Fed borrowing programs. Pandemic-related regulatory guidance for working with borrowers, which is anything from TDRs to how you're reporting past dues. We'll talk a little bit more about that when we get into some of our questions. If you operate in different states, there are different operational guidelines by state and by industry. We're seeing, restaurants and bars open and close, gyms open and close. So they're varying by state, by industry, and in some cases by county. And they're changing daily. I know here in Florida, we have cases, increasing cases, decreasing cases, and they're definitely affecting different areas different ways.
Yeah, so obviously probably the most popular question, I guess, that we've received, and as Allison said, we've kind of tried to group the questions into broader categories so we could hit as many topics as we could here. Obviously, this platform is meant for y'all to literally ask us anything, and we'll do our best to respond to y'all in terms of what's going on in a particular area at a particular time. And so the most popular question is, how does the pandemic impact my allowance? And we'll get into some details here, but as most everybody knows, there's two primary components to the allowance. There's your general allowances, your ASC 450 or FAS 5 pools, and then your specific allowances for impaired loans. And we're gonna talk through the impact that the pandemic may have on your allowance, and how to factor it into your thought process and decision making when you're putting together your allowance estimate. And then, as Allison mentioned, we also have regulatory guidance out there. There's been quite a bit of back and forth related to the interagency guidance that came out in March, related to short-term deferrals and the ability to not necessarily call those TDRs or impaired loans, not call them non-accrual loans, or even past due in most cases. And then you had the CARES Act legislation that came out, which complicated it a little bit because the rules were a little bit different in the CARES Act than what the regulators came out. And so then I guess it was in, Allison, what was it, April maybe? The regulators put out some more information, which kind of reconciled the two documents. And so we'll hit on that a little bit as well as we get into this. But as we mentioned, the overall, or as we're going to mention, the overall impact to the allowance as we currently sit is more than likely going to be in the qualitative factors area of the general pools. And we'll get into that in a little bit more detail.
Yeah, that's where we're going to spend, the majority of the time, probably our time together today, is with the next question. That's the next, the next question we get most often is, how is this going to affect my allowance? And we say, well, you'll probably do it through your qualitative factors. And then, okay, well, which qualitative factors do you think would be most impacted? The 2006 interagency statement has 9 factors. Those are not exclusive factors. They're not the only things that you should or could or would consider, but they're the 9 that the regulator specifically mentioned. And what we've done on the next slide, and Chris and I'll probably do this a little more conversationally, but this slide here they are. Here are the 9 that they talk about. And what we've done is tried to highlight the ones that we think would be the most likely to show increases in your institution. You probably haven't changed your lending policies and procedures. I'm sure, if anything, you have strengthened your underwriting standards, maybe taken a look at your charge-off and recovery practices, but those are probably not significantly impacted. The same with your experience and ability and depth of lending management and other staff. You probably haven't made very many changes there, unless maybe you have lost an experienced lender, or you have hired somebody that maybe has more SBA lending experience if you've participated in some of the SBA programs. You probably haven't seen a whole lot of, given the regulatory guidance, a whole lot of change in the volume and severity of your past due loans or your non-accruals at this point in time. And hopefully you haven't changed the quality of your loan review system. Hopefully you're continuing your loan reviews, whether you're completing those on-site or remote. Hopefully you are continuing your loan review process internally and then externally if you have one. The factors where we think that you would have the ability, because these are not going to roll through your historical losses, would be more of your changes in the in your international, national, regional, and local business conditions, including that affect the potential collectibility of the portfolio. This could be divided into your various market segments. It depends on how your institution structures your loan portfolio and structures your allowance calculation around that. The nature and volume in the terms of loans, if you have given forbearance to quite a few loans in your portfolio or any loans in your portfolio, this may be where you could capture some of the risk associated with that. The changes for collateral and underlying collateral. It's something that you may not have thought about, but if there are deals that are not closing, the real estate market around us right here in Florida right now hasn't been hit very hard. There's still home sales are still continuing on. But from a commercial side, if you are seeing commercial deals fall through in your area, if you are seeing any sort of economic change from that perspective, what is that doing to your underlying potential for your underlying collateral? And then any concentrations. You're probably reporting concentrations to your board, whether you have concentrations in hospitality, hotel, restaurant, any of those sectors that could be most affected currently by the pandemic. How are you handling those concentrations, and are they in your allowance calculation, and how much is in each portfolio, and then how much of those may have been given any kind of forbearance? And any other external factors that you may have, legal and regulatory requirements, anything like that may be out there that you can capture in the ninth factor. And it's really important to document. Document what you're thinking as you're going through these. This should be some, especially in this second quarter, there should be some changes from your first quarter, for sure, from your first quarter evaluation. There should be some changes in these factors. You would expect to see some movement.
Yeah, that's right, Allison. And there's another question a little bit further down, further along that I don't want to get too far ahead of myself. But obviously, why we're focusing on the qualitative factors is because the vast majority of the institutions out there, if you're looking at a historical loss situation, it's zero or very near zero, because there have not been a lot of losses over the past several years. And so you really don't have a historical loss basis to increase your allowance. So that's why obviously we're focusing on the next piece, which would be the qualitative adjustments, which are used to, in essence, adjust your historical losses to what's happening currently in your portfolio and in these factors. And then another thing to point out, and Allison mentioned this, is these are the original 9 factors that were in the 2006 guidance. It's not, these are not the only ones. You can use others. You can customize them, obviously based on your portfolio. We've had questions come through about, well, could we also add a new factor for COVID-19 pandemic? And the answer to that's yes, you certainly can. There's no prohibition to doing that. Obviously trying to determine what the impact to your portfolio is the difficult part. Where you adjust it is not nearly as important as trying to figure out what the impact is going to be. And as we'll discuss, right now, most institutions really don't have any idea what the impact is going to be, because there's not a lot of past dues, as Allison said, not a lot of non-accruals. We fully expect that things over the course of the next 6 months, maybe to the first half of next year, it will become more apparent, I think, that which loans are potentially problems and that we have to deal with. But right now, there's just not, not enough there. So so we're talking about potentially trying to ratchet up the allowance through our qualitative factor adjustments here.
That's right. That's right. I think the general consensus, I don't know that anybody believes that there will not be an impact. The question is, how severe potentially is it? If you have had excess in your calculations to this point, you may not see an immediate need for provision. You may have been running an excess to account for growth or to account for other factors that other plans that you may have, or you may have had an excess just because your portfolio, some recoveries or things like that you were still fortunate to receive. So it's possible there may not be a huge impact as far as provision expense based on your adjustments, but there still should be some adjustments in your qualitative factors.
That's right. Now, Allison, a question did come in asking, can you provide some examples of what types of documentation to include with the qualitative factors? And yeah, I mean, I think we can talk about that. As most everybody knows, the qualitative adjustments are that they are subjective. They are qualitative in nature, meaning they're not necessarily tied to specific amounts or factors. Although I think, if you take the first couple of items that we've highlighted here, for instance, clearly the documentation on your economic conditions, I think you can certainly document the mass unemployment we had. Obviously, it's getting better, but it's still not perfect. I think it's 11.1% is the last I saw. So clearly there's some economic issues out there related to the virus. Terms of loans, again, here's where if you have experienced a large rate of deferral, where you've gone through some point of deferring loans for various business segments, again, documenting here the nature, summarized, obviously, the nature and volume of those loans that you've deferred, the length of the deferrals. Are they interest-only deferrals? Are they full payment deferrals? Obviously, having that information documented will assist you in identifying the potential impact to your portfolio. As again, just kind of a basic thing here. If all of your deferrals still require the borrower to make interest-only payments, well, that's going to give you some indication that the borrower is still able to pay if they're making their interest-only payments. If your deferral is a 6-month deferral period, well, you've got 6 months of potential unknown of whether that borrower is ever going to be able to start paying again. So those type of terms that you've potentially, set up would be something you could capture here by documenting, what you've got going on, and the deferral period that in terms you've enabled, and what that impact may be. Again, it is a subjective thing. I mean, you're not going to be able to say, okay, well, we did, $30 million worth of deferrals, so that equates to an extra $1 million worth of allowance. That's just not how it works. But that information should enable you to consider what the potential impact is to your portfolio and be able to adjust the qualitative factor, again, most likely up, to try to capture that risk that's inherent in your portfolio. And then obviously the other items here too, again, you can document if you're seeing collateral values change in your market, you can document that, whether it's residential, whether it's commercial. I think there's an overwhelming fear right now in the commercial real estate industry, as everybody has realized that people can work remotely, whether or not there's going to be as much leased space needed when leases come up for renewal, and the impact to those type companies in the future. you know, who knows, but it could be significant. And so again, documenting those type factors that are evident in your portfolio really would be, you know, key here.
And that's a good point, Chris, in thinking about, you know, if you have strip shopping centers, if you have properties that rely on the rental income and, you know, there's been some sort of underlying rent deferment or anything like that for the tenants of those shopping centers, how are you capturing that in your allowance? And how are you communicating with those borrowers? You know, as they come, you know, we have different regulations in different areas and different markets where, you know, rents and things have been stabilized or have been deferred. So how do they come back from that? And are the underlying businesses operational again? Will they become operational again? Looking at them and maybe matching off some of the PPP money if you have customers that participated in the PPP program and you helped them do that, you know, matching off some of those to determine your risk.
So I was reading another question that came in here related to the previous question. How could an institution determine what to apply to the portfolio to calculate the qualitative factor adjustment? In the past, we have seen using, say, 10 basis points or 25 basis points on those loans impacted. So for a change in economic and business outlook, is it acceptable to apply 25 basis point qualitative adjustment? If not, how could you quantify the qualitative adjustment factor? Whew. So, I mean, it's a great question, and again, it gets you know, gets back to the subjective nature of this.
Right.
If you know, if in your policy and in your documentation you have a threshold of, you know, if it's low risk, it's 10 basis points. If it's high risk, it's 25 basis points, or high likelihood, or however you define it in your policy, then without adjusting your policy, you're somewhat limited to those ranges. So again, if your policy says on the high side it's 25 basis points and you make the determination that the economic and business outlook is bleak in your portfolio based on the types of loans you have, then yeah, I think you would max that factor out at 25 basis points. You know, Allison, I don't know if you have another opinion on that, but I think, again, unfortunately, because of the subjective nature of qualitative adjustments, you kind of have to make a decision what you honestly believe is happening in your portfolio that's not currently captured in your historical loss numbers, and adjust it through there. You know, the downside to and you know, this is not disparaging on regulators at all. I completely understand as why they do it. But the downside to making institutions try to quantify their qualitative analysis means that you, again, kind of get stuck with arbitrary numbers like 10 basis points or 25 basis points. And if you think it should be something higher than that, you certainly should adjust it to that number through your qualitative analysis, and then just make absolute certainty that you, again, getting back to Allison's document,
Mm-hmm.
that you document why, why you feel like that threshold should be higher in this situation. And also recognize that adjusting a qualitative factor up or down is not permanent.
Right.
It is something that can be adjusted based on changes. Now, granted, that's pure accounting world, and I understand in the real world sometimes that's not how it works. You adjust it up, it's hard to adjust it back down for regulatory considerations and that sort of thing. But again, just because we're experiencing an unusual time now, should make you want to consider raising your qualitative factors, knowing that when we get through this patch, those factors can then be readjusted back to normal ranges. If when that happens.
Well, and to Chris's point, where he talked about earlier, if you max out, and it would be a policy change that you have to run through directors loan committee, board of directors and all that, you could always add a pandemic component, an additional pandemic factor, to capture some of those additional risks that maybe once this is over, we wouldn't expect to be there. It might be a temporary factor that you expect to be for the next, for some period of time, while everybody works through the impacts of this, and when the economies kind of get back open and operating back to some degree of normalcy. I think it would be important to document. And I look at it as, fortunately it is subjective. So you do have, your markets, your credits, them better than most people, or than probably your regulators and even your auditors. And so as long as you document those considerations, and if you have to go out of bounds on any of your factors to be conservative, I think as long as like any other out of policy situation that you may have, then I think it's important that as long as you get that approved in the appropriate board committee or directors level committee or loan committee, I think you can certainly do that. I think the situations and the conditions would warrant that.
Yeah, I absolutely agree. I think before we move on to the next topic, Allison, there was one other question that came in, and this question actually sums up the problem exactly with what we're talking about here, and that is, as states open and then subsequently businesses close, it seems like it'll be a fluctuating situation. How we're supposed to monitor all of this and incorporate this into our allowance calculation. It could change weekly depending on what local and state politicians allow or not allow. They may be allowed to open and then they close again. Mm-hmm. And whoever asked this question, you're exactly right. I mean, this is a very fluid situation. And I wish we'd be able to tell you that, okay, look, this is what's going to happen, and so adjust your allowance accordingly. But that's not the case. Every market's a little bit different. And so, to be honest with you, my thought or opinion on this is, nobody knows your portfolio better than you. And, if, in theory, and probably is the truth, you're talking to your borrowers on a regular basis. You know what's happening in your community, and what the potential impact could be to your portfolio. And I think it's that is literally the information that you will be using to determine how these factors are adjusted. It's understanding what's happening to your community and your portfolio, and it will change. I mean, things are going to get better, and then things are going to get worse, and who knows where it's going to go from there. And so it's just paying attention to what's happening. There are communities out there that have very little impact from a COVID-19 standpoint, and their borrowers are going to be just fine. And then there are markets that are, I hate to use the word devastated, but potential devastation on the horizon, especially in hospitality, retail, non-online retail, restaurant industries, hotels. If this thing keeps going, you could have a lot of business loss there, and that could significantly impact your portfolio. So again, just determining what's going on where your primary lending market is, and trying to adjust for that is really your best bet at this point.
No, that's exactly right. Kind of moving, I feel like we could talk about the interagency factors for we probably could have done just a whole seminar of talking about the interagency factors. And we are happy to answer any other questions as we have time at the end, or even afterwards if you'd like to email us or give us a call. We're happy to talk through any situations that you may have and help you sort through it. One of the next questions we get is, we're using a 24-month rolling average for our historical losses. Should we revise our look back? And the short answer is probably not. Unless you're looking at a time frame. Most of the financial institutions have not had any significant losses in the last, even if you go back more than 24 months. So unless your institution has something specific from a risk perspective that you feel like you could capture that would mirror the inherent losses in your portfolio, or if you wanted to do a different period, if your institution has been around a really long time and there's a period in some other economic time that would make more sense to use. I'm not sure that we're there yet. I don't know. I don't know that that's necessary at this point. See how long this goes on.
Yeah, and that's right. And I mean, and to Allison's point, I mean, for a lot of institutions, I mean, you'd have to adjust your look back period pretty large amount of time to get that back to any kind of significant loss period. Obviously the banking crisis was probably the most severe in recent history, but I mean, even to get back to that, I mean, we're talking, almost 10 years now. So,
yeah.
So adjusting your look back period is not really going to result in adjusting your allowance to where you feel like it should be. So again, as Allison said, unless you have a specific point in time, you could kind of reference that and try to use that period of time. I mean, that is allowed, but for most institutions, this is going to be a qualitative factor game to try and get your allowance where it is or where it should be, where it hopefully should be.
The next question we get is, we have a concentration in hospitality. Those are lumped, they're grouped in our commercial real estate category. Should we revise our allowance calculation and add our concentration as a separate line item? Possibly. There is so much uncertainty. The PPP program was extended, 24 weeks to the end of the year. They just extended the period for which loans could be issued because there was still money left as of June 30th. So for the short term, it may not make sense to add that as a line item, because remember, you have to, break out the historical losses and break out your qualitative factors and have the documentation to support it. So it may be something that you want to track through the end of this year, see where you are at the end of 2020, and maybe add that as a particular line item for your 2021 calculation if you're on a fiscal calendar year. It just, you may want to try to capture that with again, as we talked about qualitative factors, a special qualitative factor or some other mechanism through concentration reporting or something else. But it may not make sense to go ahead and break it out, but you could if you wanted to.
Yeah, I mean, that's right. I mean, there's no requirement on what your categories have to be necessarily. So, again, the only real requirement is that the pool should have similar risk characteristics. And so, if you determine that in this example here, that your hospitality, if you have a large hospitality concentration and those are experiencing different risk characteristics than the rest of your commercial real estate portfolio, then that certainly would be an example of an opportunity to break those out. Again, because they're not necessarily performing similarly to the other category, the other loans in that category. So while not necessarily required at this point, it is something to think about, especially, again, depending on your individual portfolio. If you see some dark skies on the horizon in a particular area, it probably would make sense for you to start accumulating that data to be able to separate that out for when, if losses do start occurring in that segment of the portfolio.
And the FAS 5 or ASC wants you to capture losses inherent in your portfolio at your specific time you're doing your calculation. So luckily, it is not a forward-looking projection. So you can, that sort of alleviates some of the pressure with the question we had earlier on opening and closing and opening and closing and opening and closing. It alleviates some of the pressure from having to forecast some of what you think might happen in the future, particularly with hospitality.
That's right.
Go ahead.
I was just going to say, so on the forbearance side, we've kind of already hit this a little bit too. Working with borrowers, trying to follow the guidance issued by the regulators, by the CARES Act. How do we report this information and quantify it in the allowance? And, realistically, most of this is going to be captured in your internal reporting, where you're obviously tracking and keeping statistics and summaries on the volume of loans that have been modified, the terms of those modifications. Again, probably more on a summary type basis, although you will want that on a loan by loan, obviously. But getting back to those 9 qualitative factors that we talked about, this is one of those components that we were talking through before. And so, tracking that information and determining what the potential exposure is in your portfolio, again, will then allow you to use that information to potentially adjust that Q factor to try and capture what the estimated loss is related to those forbearance agreements or short-term deferrals.
And if you're not reporting and you have a significant amount of customers who have forbearance, for whom you've granted forbearance, and you're not reporting that in loan committee, or not necessarily customer by customer, but by category or in some form or fashion, you probably should be. You're either your director's loan committee or board or audit committee. It's probably, you want to have a conversation so that if you have a significant volume, everybody's aware of it. The PPP loans, as the time periods keep expanding, question is, should we record any allowance for our PPP loans? Not right now. I don't think so. There's a potential for some sort of blanket forgiveness out there that we hear conversations about. 150,000, 125,000. Some wish for larger. There's a lot of uncertainty, and these have a SBA guarantee attached to them. So I don't think there's a mandatory criteria. But again, as we've talked about, this is your calculation. And if you think that there could be some inherent risk in that portfolio to y'all or to your institution, then, by all means, start showing it on, you should start showing it on your calculation if you're not. And then, add a small allowance component to it if you think that there is, that could be necessary.
Yeah, that's right. There's really, at this point, there's no information to suggest that these loans are not going to be forgiven either or paid in full, or worst case scenario, the 100% guarantee from the SBA has to kick in. That being said, while it certainly was not the bank's responsibility to certify all the information that the borrowers presented to get these loans, I think it is incumbent upon you to, if you are aware of an instance where you have made a loan that is clearly not going to qualify for this program, unfortunately, you may have a situation on your hands that is yet to be seen how that's going to be resolved. Is the SBA going to make the bank whole and then, go after the individual borrower? Is the SBA going to push it back on the bank? And maybe there's some of that guarantee that's at risk. I mean, who really knows at this point? But certainly, I think if you have that situation, that would be an example of an opportunity to potentially, push that through your allowance at this point in time.
And conservatism is one of the tenets of accounting. So if it would be conservative and give you more peace of mind, you could certainly try to, but again, you would have to justify and document your rationale surrounding that factor, and sort of how you arrived at that. We have about 5 minutes left. A couple of the publications, the examiners, the regulators keep putting out information that is helpful and provides their perspective on things. June 2020, there was an interagency examiner guidance on how the examiners are going to look at the different CAMELS factors, look at institutions for safety and soundness. It provides some good insights in an 11-page document that gives their perspective on operational risk, technology, including some remote audits if you've been doing remote internal and external audits, and things that management should be considered and things the examiners are going to consider if you have an exam coming up. The OCC, it's titled Spring 2020, but it's really a period from April to early June, which happens to be during the pandemic. The OCC released their semi-annual risk perspective. It has some good information in risk themes with regard to profitability, unemployment levels, elevated operational risks. So there's some good information there. And these could provide y'all with some of the information you need to document some of your risk factors, maybe, potentially. So some good information coming directly from the regulators. And then finally, most recently, just last week, the FFIEC issued a joint statement on managing your LIBOR transition. So if you have loans in your portfolio that you have that you've priced on LIBOR and you're going to be transitioning those, there is some good information on managing those risks as well. We have sent out links to some of these documents. If we have your email address, you may have received it. But if you wish to receive it, we can certainly send you a copy of it as well, or you can find it on the examiner's website.
That's right. So I think we're actually at about the end of our time here. Let me just check and see if any additional questions have come in. It does not look like there have been any additional questions. So, we'll open it up here for a minute. If somebody has something they want to put through, we can try and answer it real quick. You will be receiving an email after this is over with the slides. This is being recorded, so you'll have access to that if you need to share it or want to share it with others in your institution. Please don't put me on TikTok. I'm not prepared for that yet. And in that, maybe if there are additional of these type of webinars you would like to see in the future, please give us that information as well. this is something that is as we mentioned, our inaugural attempt at a potential series that we're considering, and Ask Us Anything series, which literally will open it up to questions ahead of time. As you saw when you registered, there was a link to submit questions. So you can ask questions ahead of time. That gives us a little bit of an opportunity to prepare if it is something ultra complicated that we need to research or anything like that beforehand. But then we also want it to be interactive as well, so people can ask questions on the fly as we're going through, just like we did today. So, with that, I guess, we want to thank everybody for attending, and, we really appreciate you being here with us today. And if you need anything else or have any other questions, again, please don't ever hesitate to reach out to anybody at Malden & Jenkins.
Yeah, thank you so much. Thank you to those that submitted questions early. Without y'all, we wouldn't have had a seminar, and we really appreciate your attendance and attention today. Don't hesitate to call us or email us if you have any questions.
Thank you very much. Have a great rest of the day.
Thank you. Enjoy your day. Stay safe and well.